14.7%. I mean, wow, that is just a massive number. In the world of industrial supplies and manufacturing, seeing a company post a 14.7% daily sales rate growth in a single quarter is absolutely enough to make any analyst do a double take.
It totally begs the question, right? How on earth is a traditional industrial supplier, a company literally built on selling nuts, bolts, and fasteners, putting up top-line numbers that look way more like a Silicon Valley tech startup? Well, the answer lies in a fascinating digital moat that they're aggressively building right under the market's nose.
Welcome to This Explainer. Today, we're diving deep and decoding Fastenal's Q2 2026 earnings report to figure out exactly how they're pulling this off. We're going to strip away all the boring financial jargon and just look directly at the data driving this incredible momentum. Here's our roadmap for today. We're going to hit the Q2 growth story, unpack their massive digital transformation, analyze the market drivers and trends, break down a really fascinating margin tug-of-war, and finally wrap up with their cash flow and capital. Let's get right into it.
All right, Section 1, the Q2 growth story.
So, looking at these numbers, the sheer consistency here is just remarkable. Fastenal delivered that strong mid-teen daily sales growth of 14.7% in Q2. But we really need to understand the mechanics behind this momentum. This isn't just organic volume we're talking about. It's actually partially supported by some very strategic pricing actions. They managed to push through roughly a 2.9% pricing increase in the quarter, which creates this stacked pricing impact of about 4.5%. That's totally by design, to help mitigate ongoing cost inflation. Basically, they're successfully passing on costs while still moving heavy volume. And this next part brilliantly illustrates their deliberate key account strategy. They aren't trying to sell to just anybody. They're aggressively expanding their footprint with high-spend, massive customer sites. Check this out. Total contract count was up 7.2% from last year. But get this, the number of sites with $50,000 or more in monthly spend, that grew by a staggering 16.5%. They are literally landing the big fish and then expanding their presence inside those massive accounts. Moving on to Section 2, the digital transformation, which is really the engine under the hood here. Okay, so the absolutely crucial point to understand here is that Fastenal isn't just dropping off boxes of parts on a loading dock anymore. They're essentially running a hardware-as-a-service model now. They measure this through what they call their digital footprint. This footprint is the combined sales from their Fastenal-managed inventory devices, so think of giant industrial vending machines and automated bins right on the factory floor, plus their e-business integrations where the customer's procurement systems literally talk directly to Fastenal's.
And here's exactly why this matters so much. That digital footprint daily sales grew 16.2% in Q2, completely outpacing total company growth, and it now represents an absolutely astounding 61.6% of total company sales. No way, right? Over 60% of their revenue is now flowing through these super sticky, integrated digital channels. You can actually see this heavy adoption happening in real time right out there on the factory floor. Fastenal signed 109 weighted FMI devices every single day in Q2. Just pause and think about that scale for a second. That is a massive daily deployment of physical tech into customer facilities, bringing their total installed base up 6.5% over last year. Because of this aggressive rollout, FMI alone now drives 44.6% of total sales. On top of that, their e-business daily sales rate jumped 12.6%. Customers are actively consolidating their spend and hardwiring their systems directly with Fastenal, which dramatically increases retention and operational efficiency. All right, Section 3, market drivers and trends. Let's look at the macroeconomic factors.
Fortunately for Fastenal, the broader environment is actually pretty favorable right now. The U.S. Purchasing Managers Index, or PMI, averaged 53.3 for the second quarter. Since anything over 50 indicates expansion, this tells us that despite some of the economic jitters out there, industrial production and non-manufacturing segments are showing solid positive improvement.
So how exactly does this play out across their different markets? Well, heavy manufacturing is absolutely carrying the load right now. This segment represents 44.1% of Fastenal's total sales and is just crushing the other segments, growing at over 18%. That's driven by that sustained momentum in those massive key accounts we talked about earlier. Though I should mention, construction, transportation, and warehousing are definitely still contributing meaningfully to the top line too.
And when we break down the actual types of materials being sold, there's another really interesting dynamic at play. Direct materials actually slightly outpaced indirect materials in growth this quarter. This was heavily fueled by those large customer signings snapping up massive volumes of fasteners, combined with better product availability and those pricing tweaks we mentioned. But still, indirect materials are definitely the bulk of the business. They make up 60.8% of total sales, maintaining solid, steady growth in everyday categories like tools, safety equipment, and material handling gear.
Okay, let's pivot to Section 4, the margin tug-of-war, where things get a bit tense.
Here's the main conflict Fastenal ran into this quarter. There were a few major culprits putting the squeeze on their gross margins. First off, an unfavorable net price versus cost dynamic created about a 40 basis point headwind. That was mostly due to tariff-related cost pressures and just stubborn inflation, even though their pricing actions did help sequentially. Second, rising transportation costs, especially fuel inflation, definitely took a bite. But you know what the most interesting culprit is? It's actually their own success. By intentionally shifting toward those massive key accounts we discussed, customers who naturally demand bulk discounted pricing, they are inherently squeezing their own gross margin percentage.
Because of all these factors, gross margin actually dropped by roughly 75 basis points compared to the same period last year. Now, in traditional retail, a margin drop like that would absolutely cause a panic. But wait, look at this. Despite the gross margin taking a hit, their operating margin stayed completely flat at 21%.
So how exactly did they pull off this financial magic trick? Honestly, it was incredible selling, general and administrative, or SG&A discipline that totally saved the day. They managed to squeeze their SG&A costs down to 23.5% of net sales, compared to 24.4% last year. And this right here highlights the absolute beauty of their strategy. Yes, large customers come with lower gross margins, but they generate way higher absolute profit dollars. That immense sheer volume provides the fixed cost leverage they need to drive operational efficiencies, totally offsetting that gross margin pressure. Pretty brilliant.
Which brings us to our final section, Section 5. Cash flow and capital.
All of this disciplined execution translates into one thing: strong, sustained cash. Operating cash flow is remaining super robust quarter over quarter, while net capital expenditures are kept tightly managed right in that $60 million range. They're basically successfully funding this massive digital device rollout and their physical expansion without just burning through unnecessary capital. Ultimately, if you take one thing away from this explainer, it should be encapsulated right here. Fastenal is successfully executing a massive digital transformation, aggressively capturing these huge accounts, and then leveraging those massive sales volumes to expertly defend its operating profitability, all while throwing off strong cash flow to keep shareholders happy. It's honestly a masterclass in industrial evolution. But you know, that does leave us with a critical, somewhat provocative question to watch for next quarter. With this ongoing, very intentional shift toward lower-margin large customers and the reality of persistent fuel and tariff inflation out there, can Fastenal's digital moat and SG&A leverage actually continue to hold the line on operating margins in the second half of 2026? It's definitely going to be a fascinating balancing act to watch. Thanks for joining this explainer, and definitely keep your eyes on how this digital industrial story unfolds.